Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome to my YouTube channel, Finance Specialist. Viewers, in this video, I will talk about CVP analysis in a multi-product environment. In my previous video, I have covered discussion on CVP analysis, its importance, limitations, followed by one numerical example where I have covered how we can calculate break-even point, target profit units, and margin of safety, followed by profit and loss calculation using income statement format. The link of my previous video is given in the description if you want to watch the introductory discussion regarding cost, volume and profit analysis, so you can click on that link. In this video, as you can see, I'm going to explain the same measures such as break-even point, target profit and margin of safety in a multi-product environment with the help of example. Have a look at the example. Assume that the friend's company produce three types of valves for trucks, cars and motorbikes. The following data is available. In bullet points from A to F, the data is given, wherein there are some calculations which I have already performed, which will help us in the later part of our discussion. The share in physical volume sold, the percentage share of each item, that is truck valves, car valves and motorbike valves, is given like 30%, 45% and 25%. The selling price per unit in terms of dollars, it is given 10, 8 and 7. The variable cost per unit in dollars is given 7, 6 and 5 product wise. And then the contribution per unit. It is important to know that how this contribution is calculated. So for the sake of your understanding, I've mentioned that contribution per unit is calculated by subtracting variable cost from the selling price. When it comes to contribution margin ratio is calculated using a formula by dividing contribution by sales or selling price. So here we have the contribution per unit in terms of number, and here contribution margin ratio for each product. The fixed cost, the total fixed cost given is $10,000. Let's have a look at the requirements of the question. The first requirement in this question is to calculate weighted average contribution margin for the friend's company. So let's see how weighted average contribution is calculated. We can calculate weighted average contribution by simply multiplying the given weightages with that of individual contribution of a given product. For example, for truck valves, the percentage is 30 and contribution per unit is 3. So we will simply multiply both these values. We will repeat this for cars and motorbikes, and finally we will add all the results. So here you can see I have simply multiplied the weightages with that of contributions. So we will get this way the contribution $2.3 weighted average contribution for the entire product line. So the first requirement is addressed by calculating weighted average contribution using a method by simply multiplying the weightages with that of individual contribution and then add all these weighted contributions to get weighted average contribution $2.3. The second requirement is calculate the overall and product wise break-even point, units and amounts for the friends company. So here it comes the second requirement of this question. Here you can see the famous formula, break-even point in units is fixed cost divided by weighted average contribution. Fixed cost, it's already given $10,000 and weighted average contribution we have already calculated 2.3. So after dividing fixed cost by weighted average contribution, it will give us 4,348. So 4,348 units, it's our overall break even. But since we are working in a multi-product environment, so therefore to calculate the individual units towards the break even, so we can multiply the result with the given weightages. For example, if we want to calculate for truck valves, so simply 4,348 we need to multiply by its given weightage. So it will give us 1,304 units. And similarly for car, we need to multiply the same number with the given weightage 45%. It will give us 1,957. And similarly for motorbikes, we'll do the same to get this 1,087 units. So here we can say the friends company will break even, that is there will be no profit, no loss if it sells these volumes of valves at the given proportion of 30%, 45% and 25%. So this is break even in terms of units. In the second requirement, we need to calculate the break even point in amount or sales revenue. Here it comes the formula. According to this formula, it is fixed cost. This time it will be divided by weighted average contribution margin ratio. Weighted average contribution margin ratio we had calculated at the beginning. You can see over here by simply dividing the individual contribution with that of selling price. So the given contribution margin multiplied by the given weightages, in the denominator we will divide the fixed cost with that of weighted average contribution margin ratio. This will give us the result $36,364. So therefore we can say to achieve the break-even point, friends company must sell valves for a total of 36,364. It is valid only when the proportion of sales is 30%, 45% and 25%. We can check our calculation whether at this proportion of sales the net profit will be 0 or not. So for that, simply we will multiply the individual contribution with the individual break-even units. As you can see, for truck valves the individual contribution it was $3 and the quantity, the units we have calculated, the break-even units 1304. Similarly for car valves and for motorbike valves, so their individual contribution will have to multiply with their respective quantities or units, and then we need to minus from it the fixed cost, and the fixed cost will comes, it is 10,000. So once you perform calculation on this, so the net result will become 0, which means that at that level of sales of 36,364 there will be no profit and no loss. In the requirement number 3, we will have to calculate target profit units. The target profit which the company wants to earn is $100,000. So have a look at the target profit units formula. It is fixed cost plus target profit divided by weighted average contribution per unit. So $10,000 is the fixed cost plus the target profit is 100,000 and divided by weighted average contribution per unit we have calculated above, which is 2.3. So this will give us 47,826 units. When we prepare this format to calculate whether this is correct or not, so simply what we can do, the numbers obtained in terms of units for target profit, we will multiply them with the given contribution, and this will give us 110,000, and from this total contribution we will subtract the fixed cost, which is 10,000, and then the profit will become 100,000, which means that to make a profit of $100,000 we need to sell 47,826 units. When it comes to calculate target profit revenue, the formula is fixed cost plus target profit divided by contribution margin ratio. Again, in the numerator we know the fixed cost, we know the target price, but for contribution we need to subtract selling price minus variable cost. Now we have three products with different selling prices. So therefore first we need to calculate the weighted average selling price. We will use all these weightages and then we need to multiply them with the respective individual selling price of each item. So by doing this we'll get a selling price, weighted average selling price 8.35. The same method we will apply to calculate weighted average variable cost. So we will apply the given weightages with the individual variable costs to get the weighted average variable cost. Now we have weighted average selling price, which is 8.35, and here we have weighted average variable cost, which is 6.05. So we can calculate the difference over here. So this will be 8.35 minus 6.05. So this will give us 2.3. This is what the weighted average contribution. Since we need to calculate the target profit revenue, so for revenue calculation we need to convert this weighted average contribution into a percentage. So this 2.3, to convert it into a percentage, we saw here at the beginning of the question, to convert individual contribution into contribution margin ratio, we simply divide individual contribution by the given selling price. But since we have already calculated the weighted average, so we will have to divide it by the weighted average selling price, which is 8.3. So here when you divide 2.3 by 8.35, so it will give us 0.2754. So this is our weighted average contribution margin percentage. So we will put these values here in this formula. This one I am rolling my circle on it. So 10,000 is the fixed cost plus 100,000 is the target profit divided by the weighted average contribution margin, which is 0.2754. So after solving this we will get an answer $399,348. Now we can check our answer. Let's say our sales are $399,348, and then we need to minus the variable cost. So variable cost 47,826 units we have calculated here, and these units we need to multiply them by the weighted average variable cost, which is 6.05, and this will give us 289,347 dollars. After subtracting them, we will get a contribution, and then after subtracting fixed cost, which is 10,000, the profit comes 100,000. So this is another check whether our calculation is correct or not. So so far we have learned the break-even units, the break-even sales revenue, and also target profit units and target profit revenue. And the first requirement we had already calculated, weighted average contribution. Now we'll proceed to requirement number 4. Now the fourth requirement, as you can see, that assume that the current sales amount to 25,000 units with the average selling price of $5 and the break-even point equals 5,000 valves. Friends company is evaluating a lower level of sales, target sales of 15,000 units. We need to calculate the margin of safety in terms of units and sales, and we need to comment on our findings. So here it comes, part 4. A point to note here is the break-even point, which is the assumption, is 5,000 units, but the company is targeting the lower level of sales of 15,000. So to calculate a margin of safety, we will use the company's target. So as of now they are having 25,000 unit sales and then minus 15,000 which they have targeted. So in this case it will come 10,000 in units. The margin of safety, their sales are 10,000 units over and above than their target level, the minimum level of sales. And margin of safety, when we calculate in terms of dollar value, so we can simply multiply this 25,000 with a given average price of $5, so it will give us $125,000, and 15 into 5, it will give us $75,000, and the overall it will come $50,000 in terms of sales revenue. Normally when we calculate margin of safety, we take our reference point as the break-even. So down there, the margin of safety, the ratio which I have calculated, it is between the lowest target and the break-even, the actual break-even. So the lowest target which company has already identified, it's going to be 15,000 or 75,000. So we can calculate a ratio 75,000 minus 25,000 is their actual break even, 5,000 valves, and then divided by the lowest target and multiply by 100. So this will give us 66.67%, the margin of safety. So here we can say that when we look here, 10,000 units or $50,000, and in terms of percentage it is giving 66.67. So we can say that such a large margin of safety indicates the soundness and financial strength of the Friends company. So students, I hope with the help of this example and all the viewers, you would have understood that how we can calculate break-even point, target profit, and margin of safety of multiple products using CVP analysis. So that's the end of my video. Thank you very much. Those who have not subscribed to my channel are requested to please click on subscribe button and click on the bell icon and select all, so that you will be able to get the future videos, the intimation in advance. So thank you very much. Stay blessed.